Amazon. The reason that Steve and I have both underperformed this week, at least, well, a big part of the reason that Steve and I have underperformed so badly. Stock is down 8% today, or it was when I looked earlier. It's Friday, the 1st of August. That was in pre-market, and we got to about that in the open trading. The latest report was, well, apparently not that good, but revenues were up 13% to $167.7 billion, 12% up if you count FX neutral, which I suppose we should, because we often seem to view it as a kind of sign of management that they're not really responsible for FX shifts. 12% higher. Earnings per share were $1.68, which was up 33% from where they were a year ago. The favourite thing I always look at here is the breakdown of where all these sales growth things are coming from, and the answer is everywhere. Basically, online stores, these are all sales figures, up 11%. Physical stores, up 7%, who cares? Third-party services, up 11%. Ads, up 23%. Subscription revenue, up 12%. AWS, up 17%. And everything else, up 19%. Stock-based comp came down by 3%. Amazon is a company that's historically had quite a lot in the way of stock-based comp, kind of not cutting into its free cash flow, but cutting into the way you should think about its free cash flow. So that continues to move in the right direction. So why is it down? I saw two answers in the Trading 212 forum that I didn't like very much, so I come up with my own one for the first thing. The first one is because, well, if anyone's heard of earnings per share were down, so the stock is going down. The problem with this explanation is it isn't true. Earnings per share were up, and that seems to get in the way of that particular issue. The other one that people picked out had some traction on the earnings call, which was AWS. Growth was 17%. They are sort of they've been looking back, they've been pretty consistently between 17% and 19% year over year, every quarter since Q1 2024, and to be honest, probably before that, but they didn't bother providing any figures from earlier than that, and I couldn't be bothered to go and look them up. But 17% is basically their number. And some people thought this was very disappointing, especially given that Azure and Cloud are both pushing Google Cloud rather, are both pushing their revenue amounts higher by sort of around 30 odd percent here. Very clear they are growing faster in this case. More on that story in a moment, but here's the reason I'm skeptical about that as a reason the stock went down. It was ahead of what was forecasted. They managed 30.9 billion, and the analysts were looking for 30.7 billion. It's not much ahead of what's forecasted, but it is ahead, and a win is a win, especially on a day like today. So I'm sort of hesitant about thinking that has too much to do with the decline. Where I think things are a bit iffy is the guide for Q3. The guide for Q3 does not look very good to me at all. Sales are forecast to be up 10 to 13%. Fine. That's about where they were this time. They were sort of 13%. 10 to 13%, including a bit of a FX boost. And they were up 13% in this quarter, including a 1% FX boost. Okay, so about similar to where we are before in terms of growth. Operating income, they gave a figure of between 15.5 billion and 20.5 billion. First, it's quite a wide spread between those two numbers. And secondly, their Q3 of last year was 17.4 billion, which is sort of bang in the middle of that. So they're forecasting kind of no growth is the way you would think of that, I guess. I mean, I suppose they're saying maybe growth, but also maybe similar drop. So we call that roughly flat year over year. And look, no one wants Amazon as a flat trading stock here. What are they putting it down to? Well, not in so many words mostly, but they did use the word at least once, and the answer is tariffs. Amazon is a business that, they had a thing a few months ago where they were busy identifying the cost of tariffs and writing them into the cost that they were advertising to customers on their site. And the US government told them to stop doing this, so they have stopped doing it. But they are very clearly a tariff casualty of a sort. They are in the things business. They move things between different countries, and they import and they export, and they are going to end up having to pay for these things. So, or at least consumers are, and that's going to sort of deter them from doing business in the same way. On the earnings call, Andy Jassy was asked pretty much out the gate by the Morgan Stanley analyst about AWS and why its growth is slower than the likes of Azure and Google Cloud. They basically said here that, look, Amazon, he thinks big dog kind of AI firms are in the process of moving themselves over from training to inferencing, essentially. And as companies, a lot of AWS's customers are a bit smaller, they're still busy working on their ramp up and working out how to scale and what they want to build in these things. So he thinks there's pretty positive stuff coming down the tracks here. Exactly what quarter is harder to say, but it's very clear that there's a lot on the way in this case. And as these guys start to build out, their usage will increase. They'll likely stick with the provider they currently have, which is AWS. They have their platform for building out, which is good. They have a chip called Trainium, I think, which they think is very positive for all of these things. And they're working on their next generation and iteration of both their kind of platform, which I think might be called Benchmark or something like that. I should have written it down. And also updates to Trainium. So Jassy, of course, who was the AWS guy before he took over the top job from Bezos, is sort of fairly bullish still on AWS. The growth is clearly slower. I'm not convinced that's the reason the stock is down. I think the reason the stock is down is because they're guiding kind of weak here because they're not sure about tariffs, Steve. What did you think about any of this?
Yeah, exactly the same scenario, really, Steve. It was basically what we've said every time we've covered Amazon and we've covered AWS. AWS is an absolutely massive beast at Amazon, but it'd be bigger if it wasn't capacity constrained. And essentially, there's a huge amount of capex going on at the moment. You can see that just looking at the results. There's this massive chunk of money going into trying to resolve the capacity constraint at AWS, but they said, Nicole, don't be fooled by this. This is not gonna, this one-off payment isn't gonna solve the issue. They're gonna be doing this for years. So I think America is essentially just gonna be like data centers with roads just through the middle of them. It is kind of ridiculous how much they're spending. But yes, I thought the key points, Steve, were the bits you covered, where they've said that essentially the companies who are building AI things on AWS haven't released them to the public yet, and that will happen soon, and you'll see a huge difference. What's happening with Microsoft and with Google's platform is that the essentially ChatGPT is running on those servers, and you're seeing the actual products at work. And they think Amazon's AWS will essentially see the same growth when these products are launched. I was quite impressed with some of the stats that they came out. They said that Azure, the numbers that you get from Azure are not quite right because they include a lot of services that aren't really comparable to AWS. So if you compare them like for like, Azure is still about 65% of the size of AWS. So AWS, it should be growing bigger because it's essentially half the size. So that's kind of what you're seeing there. But they said AWS is differentiated as well, though, because it's got higher quality security and better end-to-end offerings. And the other bit that kind of stood out to me was that they said that at scale, about 80 to 90% of costs will be from inferencing, as the training will only be done sort of periodically. So that's why Amazon is focused on building its own custom silicon chips, which they think improve price performance for folks in the longer game. Essentially, what they're saying here is that, for training purposes, Google and Azure might be cheaper, but when it comes to running, they probably won't be, and that's where AWS will win. Largely, though, Steve, I thought this was a fine report. I mean, I don't want to focus on AWS too much, but I know it is the sort of jewel in the crown. But they talked a little bit about Project Kuiper, which is the low Earth orbit satellite thing. They're now firmly second behind SpaceX with a hope of hunting them down. 400 to 500 million households worldwide that don't have broadband connectivity, and they think Project Kuiper can service some of that. The DSP, which is the advertising arm of Amazon, has partnered with Roku, with Disney, ESPN, and Hulu. And that allows advertisers to benefit from the sort of signal measurement and audience development as well. That was quite a nice little bit that was hidden in the report. The other bit I saw was the insane growth of that marketing arm as well, Steve. Probably with Prime Day being in this quarter as well, but we saw a pretty decent uptick in marketing on both the shopping and on the Prime platform. and yes, broke a new record with Prime Day. It was the most number of sales, most number of items sold, most number of Prime sign-ups, and they reckon customers saved billions of dollars from independent sellers, most of which they said were small and medium-sized businesses, which probably saw their best sales performance of any Prime Day. And the other thing that was quite interesting, Steve, in there was about the Amazon pharmacy, which they said has grown about 50% year on year on what they said was a fairly significant size base as well. So to watch out for that in the future, Steve. I imagine that's going to be one of the things we see span out in the future alongside the other arms. And we'll see how that goes. Completely crushed Teladoc after I predicted a few years ago that it wouldn't make a dent. It did. It dented and dented GoodRx. They've really focused on that and done really well. So largely, Steve, I was pretty impressed with this report. I thought it could go either way. Then we got the guidance, and I thought, oh well, this will be the killer. This is going to be down a couple of percent, and then it was, and then it opened up about 8% down, and I think it stayed somewhere around there. So it completely ruined my week, but not on its own. But yeah, largely, I thought this was a decent report, Steve.
So did I. I don't like complaining about market reactions to things because it's the kind of thing I think a lot of people do without looking properly at what's going on. But to my mind, I thought this was a bit sharp, the kind of drop going on here. It puts it into territory where I think I probably have to add this to my ever-extending list of stocks that I'm trying to buy in August. I don't like it when the list is this long. I like it when there's one really obvious opportunity. Not about 8 of them that I end up chucking 50 quid into each to try and spread things around a bit, especially not in the case of Amazon because that means fractional shares. But on this occasion, I thought not convinced by market reaction to this one. Maybe there's something I'm missing there, but I'm not really sure about that as a response. I didn't think it was as bad as all that. I was impressed by the advertising growth as well, actually, at 23%. That's still coming through quite strong. If you really want to compare it to Microsoft and Google, I guess you should point out that their advertising growth is outpacing Alphabet's. Miles smaller, obviously, but that's the way things are at the moment. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.